Flint West, reporting from the macro frontier. The Deleveraging Wave, How Tariffs, Bankruptcies, and a Mature Economy Reshaped the U.S. Financial Cycle. Introduction. In 2025, the U.S. economy faced a significant policy shock, the reintroduction of sweeping tariffs under President Trump's administration. This move, intended to assert trade dominance, inadvertently acted as a catalyst for a deeper financial recalibration. This explainer investigates how these tariffs triggered a wave of bankruptcies, forced a deleveraging cycle, and exposed the structural constraints of a mature, debt-saturated economy. As the dust begins to settle, the signs suggest that we may have passed the peak of bankruptcies, but at a cost that reveals uncomfortable truths about resilience, fairness, and systemic fragility. Core sections. 1. The setup, a debt-laden, low-growth economy. By the mid-2020s, U.S. economic growth was slowing, while debt, public and private, was rising. Productivity gains lagged, and financial markets became increasingly reliant on credit expansion to sustain valuations and consumption. In this environment, any exogenous cost shock was bound to have ripple effects. 2. The trigger. 2025 tariffs as an economic shock. On April 2, 2025, President Trump launched a sweeping tariff policy dubbed Liberation Day, imposing a flat 10% tariff on all imports and up to 50% on specific countries, including U.S. allies and rivals. While aimed at reasserting U.S. trade power, the impact was indiscriminate. Smaller firms bore the brunt, while larger corporations lobbied for and received exemptions. The asymmetry accelerated financial strain for vulnerable businesses, pushing many toward bankruptcy. The consequence, a self-correcting deleveraging wave. Rising input costs, debt burdens, and soft demand coalesced into a wave of bankruptcies, particularly among mid-tier firms without lobbying clout. Total bankruptcy filings rose 14.2% in the 12-month period ending December 31, 2024, continuing an ongoing rebound in filings after more than a decade of sharply dropping totals. This initiated a broader deleveraging process. Firms shed liabilities, cut spending, and retrenched. Simultaneously, financial institutions became more risk-averse, slowing new lending and amplifying the correction. 4. The rebound, V-shaped for some, not for all. Unlike a traditional recession, this was not purely cyclical. It was structural and selective. Large firms with stronger balance sheets, global scale, and political access rebounded quickly. Smaller businesses, especially in manufacturing and retail, struggled or disappeared, resulting in market consolidation. 5. The signal. Have bankruptcies peaked? Data through early 2025 suggests bankruptcy filings have plateaued and are declining. This may indicate the deleveraging process is nearing its end, but what follows is not guaranteed growth. Instead, we may be entering a mature stagnation phase where structural inefficiencies persist despite surface-level recovery. Optional Deep Tech Insights section. Bond yields as economic barometers. In the aftermath of the tariff-induced deleveraging, another critical signal has emerged: the rise in long-term bond yields across developed economies. U.S. Treasury yields, the 10-year and 30-year yields, have climbed steadily, reflecting investors' demand for greater compensation amid fiscal uncertainty and rising inflation expectations. As of Q2 2025, the 10-year yield hovers near 5%, with the 30-year breaching 5.3%. European bonds. German 10-year bond yields have turned decisively positive, over 3.2%, a sharp reversal from the negative rate regime of the 2010s. UK gilts. The 10-year gilt yield is above 4.5%, a result of persistent inflation and fiscal stress from post-Brexit policies and global volatility. Japan's long tail. Notably, Japan's 40-year government bond recently hit a yield above 2%, a record high, signaling that even Japan, long insulated by ultra-loose monetary policy, is seeing cracks in its yield curve. Implication: higher yields mean higher debt servicing costs and waning investor confidence in the ability of governments to manage their debt sustainably, especially as central banks retreat from bond-buying programs. In the U.S., this increases the pressure on the Fed to monetize debt directly or risk crowding out private investment, another hallmark of Japanification. Conclusion: the 2025 tariffs were not merely a trade maneuver. They were a blunt economic instrument that sparked a controlled burn of weaker corporate entities. Bankruptcies rose, capital flows tightened, and the market began consolidating around firms with deeper pockets and better connections. At the same time, global bond markets began flashing red, with long-term yields rising across the board, suggesting that the cost of capital is no longer cheap nor abundant. This was not a natural deleveraging cycle. It was an artificially induced purge, one that allowed policymakers to buy time and space for sovereign refinancing. The cost? A wave of lost jobs, shuttered businesses, and the quiet rise of a kleptocratic structure where only those closest to power survive. In the absence of fair, endogenous correction mechanisms, the U.S. economy is beginning to mirror Japan's, with the exception that the dollar's global reserve status is buying a little more runway. But even that cushion is wearing thin. Timeline of events, 2024 to 2026. This is how the burn progresses over the next 12 to 18 months. 2024, trade deficit peaks, bond market jitters begin. Early 2025, Trump's Liberation Day tariffs enacted, April 2. Mid-2025, bankruptcy filings crest, yield curves steepen. Late 2025, market consolidation sets in. Labor slack emerges. 2026 and beyond, Japanification creeps in. The dollar's reserve status? Under pressure. Future implications and emerging trends. Here's what's coming as the smoke clears. Industry consolidation accelerates as weaker players exit the board. The Fed is cornered, forced to monetize debt or lose control of treasury markets. Capital scarcity deepens for smaller firms and new entrepreneurs. De-dollarization rises, led by the global South and the new majority. Here's a visual metaphor for what's happening in the U.S. economy right now. A forest fire that clears the underbrush, but it's started by the park rangers themselves. The blaze spares the tall, fire-resistant trees, big corporations with lobbying muscle, while letting the smaller flora burn to ash. Small businesses, marginal players, collateral. The deleveraging wave. A Flint West dispatch.